GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's the Phil Jackson to your Michael Jordan, here to guide you to glory. I'm your host, Jay Hamilton, and today we're joined by Ryan Watkins. Ryan is the co-founder of Syncracy Capital. Now, this is a hedge fund making high conviction, concentrated investments in, you guessed it, crypto. So today, what do you think we're going to talk about? We're going to talk about some of Ryan's highest conviction bets right now. We're talking about Solana, talk about Hype. If we have time, we'll talk about Celestia too. I hope we have time, but there's just so much to talk about with Ryan. Before we jump in, guys, we got a surprise for you. Starting tomorrow, every Saturday, we're going to have a new piece of content coming out at 3 p.m. Eastern. So hit the subscribe button to make sure you get that new piece of content because it is straight fire, so much alpha. You guys are going to love it. Also, if you're running a crypto brand out there or a media company, we want to partner with you. We are growing so fast right now, and we want to support other crypto brands that are also looking to grow and get in front of the next users, the next investors, and the new people in the space. So hit the link in the show notes to become a sponsor or to partner with us. We'd love to work together with you, and you could get in front of our audience of hundreds of thousands of crypto natives. Hey guys, in 2 weeks is one of the biggest crypto conferences. I'm talking about Consensus Hong Kong, and we've partnered with them to get you guys 15% off tickets. That's February 18th to 20th in HK. Some of the biggest names and brands in the space are all going to be there speaking. And if you want to work in crypto, or you just want to get a sense of what is the vibe and what matters right now to the builders in the space, which often gives you an edge on your investments, you're going to want to check this out. Hit the link in the show notes. Use the code MILKROAD to get 15% off your ticket today. With that, Ryan, welcome to the Milk Road Show.
Yeah, thanks for having me on.
Man, super, super excited to have you. Can't believe it's our first time getting you on the show. Hopefully, it's the first of many. I got to start with I'm going to share a couple of your recent tweets because I want to set a little bit of context of where we are right now. So, on January 21st, you tweeted, "Anyone hoping for a return to the easy days where you can blindly buy anything and expect to make money over time is fooling themselves." Then, on February 1st, you also tweeted, "BTC at 102, most alts near or below summer 2024 lows, select assets like Sol and Hype outperforming year to date, but clearly pointing out things are a little bit different." And then you also retweeted a tweet from Matt Hogan, who we've had on the show a few times, where he said the traditional 4-year cycle is over in crypto. Is this cycle different?
Yes, it is. And this isn't to say that we won't have cycles anymore. We will for sure have cycles. I think it's like this a natural feature of financial markets. But what drives returns for assets in crypto, I think, will be a little bit different. So to unpack this, really the key theme so far from the lows in 2022 until now has been asset return dispersion and Bitcoin dominance rising. And I think on the latter point on Bitcoin dominance rising, well, Bitcoin very clearly kicked off this entire bull market with the ETF, and that just had a very clear like structural bid, all these institutions piling in, and that was like the big catalyst to kick this off. Meanwhile, a lot of the almost everything else, I still think sentiment wise was dealing with the overhang of last cycle and then FTX, and there's this general sense that none of this did anything, it's worthless, and to be fair, there was also a lot of constraints on the regulatory side that prevented any of this technology from being used or from these products from even growing. So I think unsurprisingly, you've seen a lot of dispersion. And this is also, I think, a sign of the asset class maturing. And this is actually a good thing because I don't think that it's productive use of capital for everything to go up indiscriminately, because then that way quality teams and builders aren't being rewarded for doing anything, and it's sending the wrong signals that you can just come in here and you can just build some nonsense, get funded, and then cash out a couple years later when this all gets liquid. And that's not what's happening anymore. And maybe one final point I'll add to what's creating this dispersion is that, and this was like one of the original theses for Syncracy when we first launched in 2022, is that we are starting to see the early signs of winners emerging in select sectors. And that was not the case early on in prior cycles. And what this creates is a situation where the incremental dollar that's coming into the asset class is less likely to want to bid the shiny new object when there's already leaders that you can clearly see are starting to reach escape velocity. And you can see it in the metrics, right? It's no longer this argument about, oh, this system is technologically superior. Oh, like I like this founder better. Those are like qualitative points of views. This is now like you can make like quantitative arguments for why this stuff is actually starting to run away with it. And that's good. I think it's actually better this way when people are investing, not just speculating.
Okay, this is a great lead in to you wrote a article recently called "The Tale of Two Markets." I'm going to link to it in the show notes. Everybody should go read this article. It's fantastic. It is basically where you break down your hedge fund's investment thesis for 2025, the way you see crypto right now. Can you explain this thesis to us? And I know you're kind of touching on it with what you're saying, but let's dive deeper into it.
Yeah. I think as I was, writing, I think I was writing like a letter recently, and I just was thinking about how sentiment was so split on Twitter, and then among people I'm talking to, people who've done very well this cycle, people who've done very poorly, people who are very optimistic, thinking about the institutionalization of this asset class, then people who are very pessimistic, looking at all the stuff that's happening on chain, just with meme coins. And I'm just reminded of when I'm in high school and I read the book, Tale of Two Cities, and there's that opening quote from it that says, "It's the best of times, it's the worst of times," and it's just really contrasting these two different cities. And I thought the same thing is happening in the crypto economy, where if you look at Bitcoin and maybe some select assets, it really does feel like the best of times, right? Like this is the dream that people have been thinking about for a very long time, that you would have like a sovereign bid coming into Bitcoin. You would have the institutionalization of the asset class, everyone in the world getting off zero, regulation. Like this is like the Super Bowl for Bitcoin. And then on the flip side, you have like, I mean, just that absolute like nihilistic casino of people just gambling their life savings, like losing money, people extracting wealth from the asset class. And that just doesn't seem right at all. So what is like the through line of all this? Because once again, it's like depending on which one you look at, that can completely change your views. And the way that I think about it is that these are really just two sides of the same coin, and it's a slightly a nuanced view, and it can come off as just me being blindly accelerationist when when you talk about how like all this speculation is good. But for me, when I zoom out on what are we doing in what is like the grand project of the crypto economy, it is about uh, basically creating a new system of property rights for the world, and getting and allowing people to access this new system. And this is important for me because this is the foundation of wealth creation. And there's like countless, I think, economic literature that shows this. I even have like a chart in there that shows a very strong correlation between property rights and GDP per capita. I think this is very important. And what in practice do blockchains do? Because there's all different use cases. We talk about stable coins, DPIN, Bitcoin, whatever. I think what blockchains really do is they just enable you to transact and enforce contracts without intermediaries, right? And that's like very subtle, but it's very powerful. And that is actually the foundation for everything we're doing in crypto, right? Even things that may not seem like it, like DePIN. Like DePIN, in a way, you're just creating new assets and putting it on chain, right? You're like financializing all these different physical and digital resources and allowing people to trade them on chain, which I think is very very fascinating. Um, so that is actually the core thing that we're doing here, right? Enabling people to create assets, to transact with those assets, and then enforce these agreements on chain or in the cloud. Then what ends up happening when you put this power into the hands of anyone on earth? You get a lot of crazy stuff happening. And I make an analogy to the dot-com boom, because I guess it's the other very relevant technological bubble we've had in the internet age. And in a way, what's happening, I think I put out like a recent tweet about this. It's almost like a dot fund boom, where you just have, because it's now so cheap to create assets on a blockchain and trade them. People are just creating, I mean, any asset you can imagine, and this ranges from a lot of stuff that's like really ridiculous, this outright scam, just nonsense. I mean, there's like tens of thousands of these being created every day, to actually projects that will actually make a lasting impact on the industry long term. And I think for me, like the purpose of this whole explosion of assets, while it may seem frivolous on the surface, is that we're just getting more assets on chain and we're getting more people on chain. And so long as directionally that is what is happening, I think we're going to succeed as an asset class, because we just need to get more wallets in people's hands. We need to get more wealth on chain. And then as we do that, of course, there will be boom and bust, but over time, the slope of it will be that there's more people doing this over time. And once we have more assets on chain and more people using it, we can find productive ways for them to use all this stuff. And I think that's what's exciting to me. When we think about what's going on underneath the surface of all this, right? Like all these assets being created and speculation, you start to see that, even though it may seem so ridiculous and so speculative and mostly worthless, you actually are seeing winners emerging underneath the surface that are powering all of this new financial activity. And it is uh, important, because we are stress testing these systems before we actually have really high value financial use cases. Like, I'm telling you, when it's time for us to actually living our daily lives on a blockchain, we want to make sure that this stuff works. The last thing you want to do is you want to pay for a hospital bill and you can't pay for it because there's Solana's down. That'd be nuts. But we won't have that issue if we just keep pushing these systems to their limits before we end up doing that. And then the second thing too is that we're just, like I said, we're just getting more users on chain, we're getting more access on chain, and that should have a compounding effect as well. And I think maybe that's where people are kind of missing, what's happening here, as like not being totally nihilistic, is that there is like infrastructure that is maturing, that is investable, that is actually producing real cash flows underneath the surface. And you can actually own this and underwrite this as a fundamental investor. And that's really what the thesis is here. Like that's this the through line through it all, is that this whole idea that speculative and fundamental crypto are totally separate is not quite true. And if you just were to dig
Mhm.
underneath the surface of all this speculation, you can actually find what may actually be, the next fangs of the crypto economy. So that's, I think, very high level, what the thesis is about, what the essay is about.
Yeah, so I think and I completely agree with what you're saying. I mean, we're in a fascinating space where there is great things being built that are capturing institutional level interest and investment, and then there is a million shitcoins being built that are capturing media attention and getting more attention than some of the great things that are being built. So it's very confusing. It's very hard to invest in this space. There is an overwhelming amount of information. There's a lot of bad information. So it makes it very tough. What I love about, and I want to continue down this path of this thesis that you have for 2025, is what I love about the way you put it is that there's a way to invest in both sides. There's a way to capture this speculative, what you might call financial nihilism. That might be a bit extreme, but it is true to a certain extent. The gambling casino of crypto. And then there's also a way to capture the fundamentals. How do you do that? How do you get both?
Yeah. So our sense is you just need to look at what people are doing on chain and being honest about it. I have the general sense that many people who've been here for a long time are very ideological or ideologically motivated, and that's great. I think we do need people that just want to do the right thing and are here for the right reasons and keep the big picture in mind while everyone is going through this period of a speculation. But what sometimes that creates is this sense that, or what it sometimes create is people forcing what they think should happen onto the market when that's not actually what's happening. So what does it mean tangibly? If you look at what's driving demand for block space right now, it is this trading. It's trading and it's everything that revolves around trading. And if you look at all of the highest revenue generating applications on blockchains, they all center around trading. It's these, you know, Telegram bots. It's the trading front ends. Uh, it's the trading protocols, right? Like the order book exchanges, AMMs. It's stable coins, which people use to onboard onto blockchains in the first place and then start trading with them. And this is what is driving the usage, both by in terms of the revenues collected and also in terms of gas consumption. It's just all centered around trading. So what does this mean? It means that you basically, if you're investing fundamentally, you just want to be long the volumes, right? Like that is the bet that you're making here over the next year. If you think that we're going to continue on in this speculative period and there's going to be more users and more wealth that comes on chain, is you just want to bet on volumes. And that way, you don't actually need to invest in any of these meme coins, right? Because that is becoming, I think, an increasingly challenging game to bet on them individually because there's just so many. There's like an explosion of them. But you can just collect you're getting a take rate on all that, right? And the good thing about this too is that whatever is getting the most usage right now, right? Like the chains, the exchanges, the trading interfaces, et cetera, the stable coins, those are probably the ones that are most likely to be used long term and to win long term. And maybe one reference I'll make is I'm just going back to DeFi Summer. DeFi Summer, I know people remember it as this like idealized, uh, period where we were doing real things, and that is true. Like we basically went from the expectation heading into 2020 after the 2018 bear market was that like literally none of this worked. It was all ideas, it was all white papers. So the fact that we now had working protocols was a big aha moment, even if they were very clunky. And that was what people started to reprice, like the expectation that, oh wow, you know what, this stuff actually works. Like maybe like how big could this actually get? But DeFi summer was also a period of rampant speculation as well. I mean, the entire uh, paradigm was built around this liquidity bootstrapping mechanism, which was liquidity mining or yield farming. And that was very just gamified as well. And it almost is not too dissimilar from meme coins. It's like a different form factor of speculation. But the effect of it is that by in the beginning of 2020, I believe there was maybe $3 billion in assets on chain, like in terms of like locked in smart contracts. And then even by the end of the bull market or at the bottom of the bear market in 2022, right, this is after the peak, we still had around $100 billion in assets in smart contracts, right? So this stuff actually did like this capital, these users, they're stickier than many people would believe. And that's when I go back to the point about making about meme coins here and all the trading that people are doing on chain is that like once again people can say, oh, all this is not sustainable, it's going to be a boom bust cycle. But my intuition is that it will be very similar to DeFi summer when this all cools off at the end. There's going to be a lot more users on chain, there'll be a lot more assets on chain, and that's good. Because like I said, you're like the purpose of this is we just want to get as many people as possible to get their wealth on chain and start participating in this crypto economy.
Hey guys, quick break from the episode. I get asked a lot what credit card I use to spend my crypto dollars. If you're like me, you got money on chain and you want to spend some of it for everyday stuff. You want to buy coffee, you want to buy flights, that sort of thing. Well, I use the crypto.com credit card and I recommend you guys check it out too. I like it because there's no annual fees. You get cash back in crypto. You get a bunch of perks and benefits like Spotify subscription for free, Netflix subscription for free, and a bunch more. And also, you get lounge access. If you're a traveler like me, great to have lounge access as you go. So If you want a great credit card to spend your on-chain dollars, check out the crypto.com card today. Link is in the show notes. Now let's get back to the show and hear more from Ryan Watkins. Completely agree. And it's where it is very difficult when you have one of the main issues that I see is this, and I see this because of being in media and producing content every day. If I put a very bullish piece of content out there about a token, even if it's not a fundamental token, we will get more views because that's what people want. People want the speculation. They want the 100x return, right? And there's this expectation that has been created within this asset class that is what you're here for. Oh, like the idea of I interviewed Johnny Matthews, is a macro guy, super macro the other day, and he did 26% last year, and he was fucking pumped about that. Like he was like, and he's a TradFi guy, so in his world, 26% return is amazing. And I was like, Johnny, if I tell our audience that on our show, like I don't even want to say that number because our audience will stop listening to you because they'll be like, nah, that's not what I'm here for, right? So there is a misaligned expectation. The wild thing to me though is that it's so. I mean, I don't know about you, but it feels like it's so easy to do well in crypto. It's so just if you just keep it simple as your thesis presents, but so many people get in their own way in that process. And I want to get to talking about some of the assets and the specific tokens that you really like. But before we get there, I just want to bring up this chart from your recent report where you talk about how winners are emerging, because this really shows to me how easy it could be to invest here. You've got this great chart where you talk about the different categories of crypto where winners are really emerging. Can you just walk us through this?
Yeah, so basically what we wanted to show here is how I mentioned how underneath the surface there is infrastructure, exchanges, trading interfaces, the underlying blockchains that are doing very well fundamentally. And not only are they doing well fundamentally, but they're starting to consolidate market share over time. So you can start to see these becoming big winners. And yeah, that's basically what the chart is depicting. It's showing you like kind of like how market share is trending and how like some of these top players in these different sectors are now basically just dominating the market. So yeah, that's really what all it's showing here.
And it's wild. Like top three blockchains, 93% of the market. Top three
Yeah.
stablecoins, 93% of the market. Top three lenders, 85% of the market. Top five dexes, 60%. So dexes are still a little bit more distributed. But wow, like that just okay. So here's the natural question that I have is we keep seeing L1s launch. I'm not going to name any names, but every day there's, especially in bull cycles like we're in right now, and we're going to see even more coming. Is is there opportunity? They get a lot of attention, right? Like new L1 launches get so much attention. Is there still opportunity, or have Ethereum and Solana captured most of the market and they're just breaking out, and Bitcoin obviously, but from a smart contract perspective, is it a done deal in your mind? I know you don't have a crystal ball and it's difficult to predict the future.
Yeah, I think there's opportunity, but the window is closing. And maybe some historical context here is important. Why is everyone so obsessed with L1s? I think it goes back to Ethereum. Ethereum started off as a proof of work cryptocurrency and introduced smart contracts. And the asset that people compared it to back in the 2014, 2017, or 2018 era was Bitcoin. It's like, oh wow, it's like Bitcoin with smart contracts. That's great. So what do people do? Well, that is their point of reference for how to value Ethereum. It's priced relative to Bitcoin. And mind you, when it's a proof of work asset, it didn't collect any fees. Those fees were going to miners, just like it did with Bitcoin. So people thought of it as a currency. I think the legacy of this is that all of these L1s are still subtly being compared relatively to Ethereum and then Bitcoin. And what does this create? Well, now when you're launching a new L1 and it comes out and it's, or maybe even just going to the seed stage, like you're seeding some new L1, and you're seeding it at $50 million, which isn't cheap, like a seed stage company. But when you have this idea that, oh wow, this is, I don't know, potentially better than Ethereum, and Ethereum is trading at 300 billion, well then it looks extremely cheap, and it's very easy to underwrite extreme returns. And the same thing for when they go eventually go public and they're at 1 billion, 2 billion, 3 billion. Once again, like these are not cheap valuations for a product that just launched and doesn't have any users, but people can still imagine that this should be worth like 100x more because in theory a peer is worth that much. And you know what? Before any of this stuff was being used in mass, you could actually make that argument, because what is the difference between the one that's valued at 100 billion versus the one that's valued at 5 if none of them are going to use it anyways? And that's kind of why I think the L1 trade works extremely well historically, and why people still want to play it today. But what is the difference? We're looking at that chart that shows the top five or top three chains by fees. Well, the difference today is that you actually do have L1s that are doing extremely well and have basically captured the entire market. And these are strong network effect businesses. And long term, I think is going to get these things have compounding advantages. And it's going to be very hard to break into that market without any kind of unique value proposition. So I think the opportunity is still there. The window is rapidly closing for the reasons I mentioned. And I think that if you are going to attempt to break into this market, you can no longer start general purpose. General purpose is not an effective strategy to attack one of these players, because it just doesn't provide any guidance for users on what to do on your chain, or builders for what to build on your chain. It's just too open. So what I suspect is that if there are any new L1s that can join the I don't know, Mount Rushmore of
Mhm.
blockchains, and kind of challenge Bitcoin, Ethereum, Solana, and maybe even one more. I know it's supposed to be four in Mount Rushmore, but it's really just three in crypto. Um, if there's anything that's going to do that, I think they probably have to start application specific first, and just get a find product market fit in his application, get the usage, get the captive user base, and then only then can you start to expand horizontally or vertically integrate. And that's what I think. If we do have any new ones that kind of reach this level, I think that that's probably how they'll start this application specific.
Yeah. And let's point directly to Hyperliquid here as the prime example of what you're saying. I don't want to talk about Hyperliquid quite yet, though. The one thing I just want to point out, though, to everybody listening is not everybody shares this view. And there is still, I think, going to be quite a quite a way. So I agree that the window is shrinking. For like from a fundamental perspective, the opportunity for a general purpose L1 to join Mount Rushmore is very low probability at this point. There's way too many L1s. There's way more L1s than there can be on Mount Rushmore. There's only really one more spot if we say it's four, but I don't know, maybe it's five in the end.
Yeah.
Maybe it's only one or two in the end, right? Like, let's be real. It's probably going to be a few that control the majority. So, but the VC money is still going to flow. There still is, as you said, there's still going to be VC appetite for a while, I think. And retail money will also definitely flow because there's still this belief, as you said, of this hype of like L1s are where it's at. And that's the safe fundamental bet in crypto. And okay, the next L1 could be the next big thing. So I think as an investor, you have to be really careful when you're looking at this, because it's very easy to say, oh, that's an L1 that got VC funding. It must be fundamentally sound. It's not a meme coin. It must be, VCs are in it. Somebody must have done the research. It must end up being good, but it's not. I think you just be very, very careful there.
Yeah, I'm with you. I think that this continues until you have these investors start to lose money, right? I mean, So we talk about how the window is closing, and we see recent launches does not do as well. It's the same chart every single time. It gets the listing, and it's just down only from there. But even after these things basically crash, they're still worth in many cases like billions of dollars, if not hundreds of millions of dollars. And the people who invested early invested at double digit millions. So there still is, like, so long as there's still easy money to be made by doing this, it will be done. So you need this like almost like public private arbitrage for these L1s to completely collapse for this trade for people to stop funding this. That's the only way it works. So maybe it's another, slightly accelerationist view of like, yeah, you know what, we probably don't need more L1s. I'm tired of it, but you know what, the only way to solve this is just to go through. You just gotta,
Mhm.
have people keep throwing money at this, and then eventually people will lose money, and then no one will do it anymore. That's the only way that this stuff works.
Oh, what a world we live in. What a world we live in. Okay, let's talk about some of your high conviction bets. Solana, Hyperliquid, Celestia, if we have time, we'll see. I want to talk about Solana first. So, uh, I think it was in 2023, you wrote your first public thesis on Solana. At the time, Solana was, I think, 13 to somewhere around like 10 to 15% of Ethereum in terms of total market cap. And you said, hey, look, this is way underpriced, right? Solana should be more equivalent to Ethereum. Today, so that trade's worked out great so far. Today, Solana's at 33% of Ethereum's market cap. Is it still underpriced?
I think for sure. So I wasn't even imagine doing an updated thesis on Solana a year after, because I just didn't think enough would change. But when we first wrote the thesis, Solana was still very much a story about its potential. You're doing diligence on the technical architecture of the chain and basically trying to prove out that this has a structural advantage for Ethereum, and that if we were going to have any kind of retail onboarding again, this is probably where it take place because it has the throughput, like the best throughput by far for doing all this. And that was like, I mean, obviously there's more to the thesis than that, but that was kind of the gist of it, right? It's just like this is the potential. Um, and then you think, you fast forward like a year later, and I mean, even now I'm shocked at the data. I was thinking that maybe this thing, gets to like within like a third or a half of Ethereum's, volumes or fees, whatever, right? Um, but what I was not expecting is it for it to grow this fast. And now when you look at it, I mean, across any metric you would deem relevant to assessing the competitiveness of smart contract platform, Solana is now on par or surpassing Ethereum. So you look at transaction fees in MEV, generating more than Ethereum. You look at the revenue that applications are generating. The applications in Solana are generating more revenue than applications on Ethereum. I don't know what is a better argument for the success of the ecosystem than its applications making money. Look at stablecoin volumes about at par. You look at exchange volumes. I mean, and this chart, right here is a little bit outdated. I mean, now it's like way higher than Ethereum and SL2s. And you just start to look at this, and I'm sitting here questioning, like, wait, what is the reason why this gap shouldn't continue to close if there's almost no fundamental argument you can make against it at this point. Um, and I thought I was going crazy, but maybe it's just a matter of time. And maybe one last thing I'll say too is, and this wasn't in that report, but after the report, I did I ran these numbers again, and what I found is that when you look at, let's say, like the transaction fees and MEV and application revenue, it's not even just that, because like that report was really just contrasting with Ethereum. But when you even just zoom out on the entire L1 landscape, I mean, the picture is even more clear. Like this thing is just dominating the field. It has more than 50% of all transaction fees in MEV, like more than 50% of all application revenue, right? I mean, it's not even just like this is like outpacing Ethereum, it's just outpacing everything in the sector. And it's starting to look like Solana has reached escape velocity and it's running away with it. And maybe the last kicker point I'll have here is that, and this data came out after we released the report, is that Solana is now winning over new developers faster than Ethereum in the L2 ecosystem. And that is very important because that might be the highest signal leading indicator of what could be built next. So
Mhm.
yeah, that was the gist of the thesis. And I thought about, okay, what are the reasons why Ethereum may still have this this the kind of valuation premium. And I thought to myself, okay, well, it is more battle tested. It's been around for a long time, and people feel more comfortable holding their wealth on Ethereum as a result. Like Ethereum doesn't have the same. Or, I mean, Solana hasn't had any uptime issues in over a year at this point, but Ethereum has really never had any uptime issues unless you count the times when you just can't get a transaction through because the fees are so high. It is kind of like an uptime issue. And then two, Ethereum has this institutional stamp of approval, right? It has the ETF approved, and it is just like available, and it's just rubber stamped by BlackRock and all these people, and Solana didn't have that. But what I posited at the time is that post the election is that this would rapidly change, and we will get a Solana ETF. In fact, you can already see like many of the major issues have already filed for this, and I think it will get approved at some point this year in 2025. And then once you have that, it's like, what arguments are remaining, right? Like you don't have this regulatory advantage anymore as Ethereum. You don't have this institutionalization advantage anymore. I mean, maybe the one metric you can cling on to is that there's just more assets on chain, like TVL, but I guess it's probably a lagging indicator, right? I mean, you looked at, for example, when Trump launched his meme coin, what,
Mhm.
3 weeks ago, the amount of stablecoins on Solana just ballooned from that one event. I mean, this stuff can change very, very, very fast. And if I'm just being forward looking here, which is what we have to do, I think it's just can continue to grow really, really fast and more far past than Ethereum. And then in hindsight, it will seem very obvious that this gap should have closed.
Yeah, it's so many points there. Just on the Solana ETF, we just had news yesterday that the Solana ETF is getting more traction because basically, for the first time ever, the SEC acknowledged a filing in a way that they hadn't acknowledged a filing before. It doesn't mean there's a deadline and we know when we're going to get to Solana ETF, but there is traction happening towards it. It is very likely that we get it in 2025. It feels there's I would be shocked if we didn't. And it could, as you said, it could happen fast. Like there's a possibility that we get it in, early Q2, maybe even late Q1. Like this could happen quite quickly.
I
Uh,
agree.
the the um the counterpoints on Solana are one, it's all meme coins. Pumped Up Fun leading the way. I mean, incredible the success that they've had, truly unbelievable. But is that sustainable? Is the big question that everybody keeps asking. And then the other point is that Solana doesn't have the scaling ability that Ethereum has because what a lot of institutions and corporations are going to want to do is launch their own L2 and manage their own ecosystem, which we're already seeing a little bit with various institutions, Sony launching their own L2 and deciding not to allow meme coins and doing a little bit of censorship. But like, I kind of get that because they want to control their ecosystem in that way. What do you say to those two counterpoints? What are your thoughts there?
Yeah. So as far as the sustainability of the activity, I am with you that meme coins uh, are like boom bust assets, and Solana will need to move beyond these to sustain itself. But I also think it's important to just zoom out on the broader context of what people are doing on chain. Like we looked at, for example, at the stablecoin volumes on Solana being on par with Ethereum. I mean, it's still, even for like these like non-speculative use cases, Solana is still about on par, if not even still surpassing Ethereum. And I think there's two ways that I assess this. Um, One is deepen. So the reason why deepen is and Solana is dominating deepen. The reason why deepen is exciting is because it is one of those use cases that may transcend the circularity and cyclicality of the crypto economy. The demand for these deepen networks is not driven by demand to speculate, right? Like if I just want to use my phone, I'm paying for 5G. I'm just paying for 5G. It's nothing to do with like prices going up. Uh, if I want compute, right, or storage or whatever, I mean, there's so many of these depends. I'm just paying for those resources, and that's what I'm doing. And you can actually see this although the sector is still very early stage, if you just look at the data for, like GeoNet, Render, Helium, the revenue is actually just steadily grinding up, even though we've had like these like cyclical periods, even just over the past 2 years. And that's very exciting. So if Solana is going to lead in that category and this category is going to be big, then I think advantage Solana over Ethereum. And then, so what exactly is like this difference between Ethereum and Solana when it comes to DeFi, right? Because DeFi still is driving the majority of activity on Ethereum and this L2s as well. I don't think there's material difference, right? It's not like people are trading Tesla on Ethereum; they're just trading a bunch of tokens. So yeah, I mean that's really how I assess it. I think that long term, this is a challenge I think every ecosystem will need to figure out. But I think directionally, like this maybe in referencing the early part of the conversation, you just want people to be here and care. You want people to just put assets on and trade there, and over time, the asset composition will change, right? Like if a lot of people are trading on Solana and there's a lot of users there, then what probably happens next is that's probably the best place where you want to go issue an RWA because you can do it. Now, the second point, and this is really relevant to what you're saying about like Solana, or sorry, Sony for Blockchain L2. Um, so I agree. You don't get the same level of customizability when building on a general purpose chain versus building a specific blockchain. That being said, I think practically speaking, what do these institutions want? I'm not sure it is that they want this like full customization of the virtual machine and to deal with these lower level infrastructure issues. I think in many cases it's about permissioning and token extensions on Solana enable you to do this. And you can basically set, okay, like only maybe these whitelisted addresses can interact with this token and send it back and forth. And then you don't really need to completely fragment the state to achieve the same goal. So that's what I'd be looking out towards when we sort of see more of these like institutional use cases come onto blockchains.
Hmm. Yeah, very interesting. Okay, let's go from Solana to Hype. Lots of people talking about Hype right now, Hyperliquid. We just talked about it yesterday on the show with Zeneca. I feel like more and more every day, it's getting more attention. What's your thesis on Hype?
Yeah, I think there's the two most profitable businesses in the history of crypto economy are one exchanges and two blockchains, just selling block space. We've never seen these two vertically integrated. This is the first time, right? So we've had Binance create Binance Smart Chain, at Coinbase create Base, but these are separate entities with separate P&Ls and have like and this is the first time we're seeing this in one package. So starting with the exchange component, the exchange has done extraordinarily well even after the airdrop when the incentives came off. And what is driving this usage? One is that it's cheaper to trade on Hyperliquid, like just straight up cheaper than it is to trade on Binance. It is more accessible. It is permissionless system. So now you can onboard anywhere in the world rather than having these regional restrictions. There was greater asset availability. So you think of the Trump meme coin launch or whatever. Like it's usually the first one to list perps for these new assets, and that is important because if you're a trader, you want things to happen timely in a timely fashion, and and that's really what's driving, I think, the usage over the past year, right? Is like those three things. It is like by far the best on-chain experience. Now, what comes next after you? Because it already is dominating the on-chain purse market. It's like 65% of the market. It's not even close at this point. And then next is, well, how do you actually expand beyond that? Well, the good thing is once you've figured out how to do on-chain perps, it's quite easy to now do spot. And the first spot assets on Hyperliquid were just like Hype. Like Hype is the most traded spot asset on Hyperliquid. And it's actually pretty genius the way that they did it because they basically said, all right, we don't need an exchange listings. We are an exchange ourselves. Let's just list in our spot order book and then force people to onboard a Hyperliquid to buy it. And then by doing that, you end up bootstrapping your spot markets and also just driving volumes. And that creates more fees. It's a little bit reflexive in that sense. And that's basically what they did. Now, the only issue with spot markets right now, and this is the case for almost any chain, is that, well, you can't access assets that are not issued natively on your blockchain, right? So if you're trading on Solana, you can't trade Ethereum. You're trading Ethereum, you can't trade Solana. How do you do that? Well, Hyperliquid is in the process of introducing spot markets for all the major assets like Bitcoin and Solana and Ethereum. And that'll be huge because if you look at the trading volumes for Binance, what does it come from? About like 70% of it is just like the majors, like BTC, Sol, BNB, ETH. The long tail doesn't matter, but the long tail is all we've basically been able to achieve on chain so far. So I think when that gets enabled, that'll be a next key step in the Hyperliquid thesis, in like unifying like this on-chain spot in derivatives market. And then the final thing, and mind you, I think this alone is a massive opportunity. Like if you can just like win market share away from Coinbase and Binance, I mean, this is still like a likely 50, $100 billion opportunity alone, right? And it is also the foundation to be the place where not only cryptocurrencies trade, but anything trades. Like eventually, like I said, we're going to get all these assets on chain. We're going to get currencies on chain. We're going to get stocks, bonds. We're going to do sports betting on chain. We're going to do, tokenized intellectual property, and we're going to find a way to get every single asset on chain. And these assets are probably going to trade where, they whatever chains are getting those volume, right? So that's a huge opportunity. Now, where it gets even more interesting is when you start to factor in the other side of this, right? Which is the smart contracts. Once again, referencing the earlier article we had on the underlying purpose of these chains, I really think that providing the ability to transact and enforce contractual agreements without intermediaries is like the whole purpose here. Well, one of the core use cases to nail for a blockchain, if this is what you believe, is the exchange function, right? And Hyperliquid is designed, it's optimized around the exchange. So as a natural next step, like once you nail that, what do? You expand into smart contracts, allow people to create these agreements that you can enforce on chain. And I usually wouldn't be excited about the ability to just, expand horizontally, like, oh, like, do we need another EVM blockchain? Like, probably not. But the difference here, and this kind of goes back to the point where we're talking about how do you actually build a competitive UL1 in today's world, is that you already have like a captive base of users that are owners of the platform because they got the airdrop, and they all use the product, which is the perps exchange. So now when you create a new smart contract platform like the hyper EVM, all the developers, they're not lost trying to figure out like how do I get users. They just build products for the users already there. So my expectation is that when the hyper EVM comes out, you're going to have a lot of applications that immediately get traction that are serving the traders on Hyperliquid. So I mean, you'll have, and these are just ideas, but you can have like a almost like a tornado cash like set of contracts that enables you to submit private orders onto Hyperliquid order book. You could have you could lend out your liquid stake type into a lending market, get interest on it, and then you can use that as collateral in the perps exchange, right? And there's all these different ways you can compose with the exchange in a very unique way that I think will drive usage and adoption of the Hyper EVM. And this is great because, like I said, there really isn't that many smart contract platforms beyond Ethereum, Solana, and I guess Base that are getting usage. And this can be one of those ones that does get the usage. And I think that's a big outcome. That is a huge outcome because now you're talking about stacking spot exchange fees, perps exchange fees, and execution MEV fees all in one single integrated system. And that is a massive fee opportunity. And I think that could actually position Hyperliquid to be the top fee generating chain in the world. Uh,
Mm.
Hyper EVM launches and if it gets traction. And that's a huge opportunity. So like I guess maybe my thesis is that this is actually something that has the potential to be like a Solana like outcome.
Damn. It's amazing. Everything you said is just so bullish, like so incredibly bullish. Like
It is
there's
a gold
so
feature.
you're just stacking so many massive opportunities. The thing that's tough for me with Hyperliquid is okay, so for Solana, it's easy to make comparisons and make projections because you have Ethereum and you can kind of see everybody. It's not hard to think about where Solana's market cap could go to, right?
Mhm.
Hype feels a little bit tougher though. Like, do you have predictions for Hype? I mean, market cap's at like 7 billion right now. A lot of people, a lot of people fading it because they're like, oh, another L1. I know it's an app-based L1. Do we have another is another in the space? But then also all these things that you're saying, it's so new, it's such a new opportunity. How do you forecast Hype?
Yeah, yeah. So I think maybe the best way to frame Hyperliquid is it's if Binance and Binance Smart Chain were one. Now, how do you figure out the value of those two combined? It's a little bit funky because BNB's value is not totally derived from Binance Smart Chain. It's also derived from Binance the exchange, and then vice versa. But I think combined, BNB is like a almost $100 billion asset, and Binance is. I've seen estimates for Binance being anywhere from like 100 to $300 billion. I mean, but I think it's very clearly like a $10 billion opportunity alone, just for Binance, let alone like all the exchanges around the world. So that's like one way you could think of it. Another way you could look at it is just do a simple relative comparison of like all the different L1s and how does this stack rank against those? And could this get higher than like a, Aptos, Sui, Avalanche, whatever, right? If this has more usage. Those are like more like the relative comparisons. You can also look at it on absolute basis, right? And this is, I think, both relevant for people who are very fundamental and traditional and just want to underwrite this on a fundamental basis and they just want to see the fees growing and they say, okay, you know what, it's generating, maybe it's at like a 500 million to $1 billion run rate right now, and I think that can get to $5 billion in the next year, and then you slap some multiple on that, and that's how you get to whatever your estimate is, and that is definitely one way of doing it. And I think for the traders too, I mean, sometimes this kind of sounds like a little bit silly, like a lot of people just don't know how to actually assess the value of any of this stuff, right? I mean, we talk about, for example, the smart contract platforms. There still is no agreed upon framework for how to value these things. Do you value them like they're money, like Bitcoin? I mean, it's kind of like a weird way of doing it. There's no way you can like disprove it, and there's no way you can ever justify whether it's like cheap or not cheap. It's just all relative. Or do you validate it based on the fees? But the problem with the fees is that, well, the fees are circular. How are you getting fees in a asset that you issue yourself? It's kind of strange. It almost doesn't make any sense, right? So there's no valuation for this. So maybe what's our agreed upon valuation framework? So maybe for some people who are just traders are like, all right, you know what? I'm not even attempt to value this. But what gives me confidence to bid this thing and to hold it is that it's growing very fast, and I can pull up a chart that shows me this thing is generating value. And I can't do that for 99.9% of assets in crypto. Like when I try to pull up a chart of how random L1 is doing or random L2 is doing, there is nothing I can hold on to that is fundamental value, and that probably makes people paper handed because they know what they're holding is worthless. Whereas here, you know that the thing you're holding has intrinsic value, right? You're getting these fees yourself. Like the Hyperliquid, the exchange, it's providing these fees. It's buying by the token, right? You can stake it. There's going to be the execution fees that you layer on top of it. That creates real value. And this is maybe even just going back to the original point we had about the dispersion we're seeing in markets. Like, there's part of me that wonders, like, why would you want to hold anything else but these real projects that have the actual like value that's discernible when they exist. Like maybe it was just fine back in 2021, 2020, or when like nothing was making any money and none of this stuff worked. It was as much of like vaporware. But when you actually have like these like actual like really strong businesses with like really talented founders and they're growing very fast and they're really starting to compound growth and win market share, like I don't see why you would not want to only own those things. I mean, this is like the beginning of the next fangs in the crypto economy. Like, why do you want to own player number five? That's just irrelevant.
Mhm. Yeah. I mean, when you put it like that, it's so simple. Is it possible that Hype becomes number 4 on Mount Rushmore?
It is possible. I mean, and obviously, it's not without risk, right? Like, I do think that, uh, for example, uh, we've never seen a chain like enshrine all this. It's like enshrine an exchange and all the infrastructure necessary to run it, like the Oracle infrastructure, when it does support spot markets, you will in a way just be like uh so almost not really say enshrining, but supporting like a canonical bridge, and that can create risk as well, right? Um, there's also this the risk that the EVM uh, doesn't quite pan out the way that people expect. In fact, there's just the risk that Hyperliquid will never be able to globally distribute consensus because right now it's just a handful of validators that are running in this same place. And what happens when you actually distribute that around the globe? Like there's this performance degrade. So there are open questions about this. But what gives you the confidence is that the team has just executed so far, and like I said, there's this clear value here. And mind you, this execution risk matters is like it's like there for everything else too, right?
Mhm.
But I think personally, I'd rather stomach the risk of progressive decentralization from a team that has proven they can execute versus the risk that some vaporware never finds product market fit.
It's like
That's it.
that's a joke to compare those two things almost. You know what I mean? Like
I
that's
mean,
that's
it sounds kind of cynical, but like
it does.
we're sitting here and like that's like people are all like cynical and tired and complaining about what's happening in crypto. It's like, yeah, like stop bidding vaporware. Like stop. Like I don't know what people are doing anymore. There's actually projects that work and are generating real value. Like maybe that's the reason why you're so frustrated because this is not like we're not an environment where it's easy mode on. You just this is a big idea. We're going to go change the world, get a million transactions per second, and then it just flops.
Yeah. Yeah. Well, and as you said, going back to your original thesis, uh, investing in some of these fundamentals. If you're long volumes, you are also capturing the trading that happening is all on that vaporware, right? So if you're on Solana, then you're probably going to do well. Like Solana to me is one of the purest bets on AI agents in the next year. Right? You believe in AI agents? Just go buy Solana. You don't need to try to pick which AI agent. You can bet that a lot of them are going to be on Solana, and Solana will do really well. You believe in meme coins? Go buy Solana. Don't try to buy the meme coin. That's very difficult. Very, very difficult. Like you basically have to decide as an investor, you're either a short-term narrative trader and you're going to get burnt a lot, and you have to be a day-to-day trader. You have to make this your job, quit your job and just do that, or just be long on these fundamentals. As you're saying, it's so simple in so many ways.
Yeah, no, I'm with you. Like, you can definitely make a ton of money just trading the narrative stuff for sure. I mean, we do that ourselves. To be fair, with like a portion of our book, but you have to be trading it. Like, you cannot hold some of this stuff. And on the flip side, I think this is how you actually get like more institutional participation in place. When like you can show like, okay, like here is how the market share is trending. This is a dominant player. Okay, these are actually metrics show this is compounding growth. Okay, here is what demand this is servicing and here's what's driving the growth. Like when you can actually tell that story, this is much more underwritable from like an institutional perspective. And that's how you get not only just like funds that are native to the asset class to start buying, but eventually when these ETFs approve, that's how you start to get like larger participation from these way bigger pools of capital. And yeah, that is the stuff that's going to get bid. I mean, quite frankly, like these people are not going to go buy something that just doesn't have any intrinsic value or clear value. That's just not going to happen. Like these people are way smarter than that.
Uh, it seems so obvious when you say it like that. Okay, let's talk about Celestia quickly. I know we're getting to the end of our time, but we have not talked a ton about Celestia on the show, and I'm curious to get your thesis on Celestia.
Yeah. So Celestia is the way I frame it is it's a dark horse bet, and basically what you are underwriting if you're underwriting it here, you're basically making a bet that demand for block space is going to grow exponentially and that the current blockchains may not be able to service this if because they can't scale enough. And that's basically the idea here. Because what Celestia is fundamentally doing, the way I think about it is there's basically two fundamental constraints on blockchain scalability. One is bandwidth, and one other one is data availability, right? And Celestia is by far the leader in data availability. It is winning all these new integrations with new L2s for this reason. In fact, many of the top new L2s on Ethereum are just using Celestia for data availability because it provides us throughput. And if you want to build an application that can actually get not just like 20,000 people flipping shitcoins on chain, but having 20 million people or 100 million people or even a billion people using this long term, then it's going to need like way more throughput than what we currently have. And that's what Celestia might provide. And we talk about too. Maybe actually we didn't talk about this yet, but there's also been this recent trend of applications starting to vertically integrate. I think Hyperliquid is in a way an example of this, but where like you start with maybe I'll use like Uniswap as an example. Uniswap started off as like a very simple AMM, right? Like you just create the pools, you trade on them, and then now you look at Uniswap today. It's like, well, Uniswap has a wallet. They have they have a wallet. They have a mobile application. They have a aggregator. They have a their own chain and sequencer. They have the AMM, and before you know it, it's like, oh wow, this is actually like a full stack application, and it makes sense why they want to do this. You can just control the user experience, and you can make it a better user experience. In fact, there's part of me that thinks that the L2 fragmentation issue could actually be addressed 90% of the way there just by having a better user experience around swapping all the assets so that it's not as complex. If you could package this into one single interface that just does it all for you and just use whatever bridge on the back end, it really doesn't matter. Then I think that's a good product, right? And I think that's a trend that we've seen in the crypto over the past couple of years. Is like this is what applications are doing. You see it on Solana too, like with Jupiter, for example, is taking the same approach. I think Pump is probably taking the same approach, right? Um, so if we're going to continue to see this trend of apps vertically integrated, then I think maybe the best infrastructure to do this is actually Celestia, because it actually provides you with the full flexibility to customize everything you want about your application, all the way down to like the virtual machine uh, in consensus. And the only thing that Celestia will do is just provide this service that, and this is like the hard part too. Like you don't want to, if you're building an application, you don't really want to deal with these like nitty gritty consensus and data availability details. You just want to build an application that people use. And what you get in return for plugging Celestia is you get to be interoperable with all those systems, and you get like the security that you need for your application as well, so that users feel confident storing their assets and interacting with your application. So that's the idea.
What do you,
Definitely like a similar situation to in some ways, like Solana in 2022, 2023, in that you're really betting on potential here because the data is still very early stage. You start to see
Mhm.
the data, like the data posted Celestia is starting to really ramp up recently as more products start to roll out. And what you need to see next is you need to see the revenue generation come out as well. And my expectation is the team has some tricks up their sleeve because I think they're a really sharp team and they've proven they can execute.
Yeah, I think my question with Celestia is just the timing, right?
Yeah.
It's like when do we need that much throughput? Because as you said, we don't really need it yet, right? Now, possible
Mhm.
that it comes quickly with regulation and all of a sudden you get a bunch more funding flowing in, but it's also possible it takes like this sort of stuff can take time, right? This might be we're not talking months here, we might be talking years. What's your thought?
Yeah. So timing is the biggest question. There is a chance that, I mean, my sense is that the inflection point comes within the next 6 to 12 months.
Mm.
And that's when you'll start to see the data like really start to inflect and people are like, aha, like I got it. And maybe you get the first application that has like breakout usage. That the only way it could get that breakout usage is by having this level of throughput. But you're right, the timing is the hardest part. And I guess maybe what I'll say with that is just an anecdote. I remember when we were underwriting Solana in summer 2023, is when we originally bought it, we weren't quite clear when the data would begin inflecting. And at that time, I mean, it was kind of a wasteland. Like no one was using Solana. And the narrative was that all the developers were leaving. So there was not really a ton of data to cling on to. Like I said, you're really making a bet on like the ecosystem, the team, and also just like the actual tech. Like you just have to do like some diligence on there and figure it out. And there was a chance that if we didn't get the Bitcoin ETF and you had the industry take off again, it could have taken another year for the data to start reflecting where we're longer. It was really hard to call that. Okay, yeah, of course, like meme coins are going to happen and like the data is going to go crazy. That was really hard call to make back then, right? If you were purely just waiting for the data to come tell you when to buy, you would have waited. You would have waited a
You would
very
have been
long.
late.
You would have been late, exactly.
Yeah.
So that's maybe the only mistake that I just don't want to make if I were to look at this situation uh, is just be a little bit too like there's and maybe what it is too is it's like a sizing question, right? Maybe you don't want to have like you want to be all in here with when you don't have any indication on like when the data is going to inflect. But you also don't want to have no skin in the game because you might be wrong on the timing, and then it happens, and you have the thesis, and it's like, well, you know, that's on you.
Yeah, completely. Yeah, sizing is the best way to put that. Get something in there if you believe in it, and then add to it over time as you follow along. Ryan, absolute pleasure to have you on the show today. This is definitely one of the longest episodes we ever done. We usually try to keep it to 30, 40 minutes, but just had to keep chatting with you and pick your brain. Really appreciate your time today.
You appreciate time as well. This is great.
Yeah, everybody, we're going to throw link to some of the reports that Ryan has written, talking about the recent ones that we talked about. His Solana thesis, we'll put that in. Everything we talked about today, we'll put links in the show notes. We'll also put a link to follow Ryan on Twitter if you want some of the hottest takes on a consistent basis. Ryan, I don't know how you do it. You're every day throwing out great takes on Twitter. So shout out, my man. Everybody listening in, between the three we talked about, I'm curious. What are you most bullish on? You most bullish on Solana, Hype, or Celestia? Let us know in the comments. Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.